Imagine waking up tomorrow, you check your portfolio, and you see $10 million sitting there. You've hit the magic number.
Right. You feel like you've completely won the game at that point.
Exactly. But what if I told you that without a very specific and honestly largely hidden architecture, touching even a fraction of that money could instantly trigger a financial catastrophe?
Yeah, that is a terrifying reality for a lot of people.
It really is. We all carry around this deeply ingrained assumption that, well, if you just work hard, save diligently, and build a massive pile of wealth, you're permanently secure.
But a mountain of money is definitely not an income.
Right. And when your personal income engine suddenly stops, the way your wealth is structured actually matters infinitely more than its sheer size.
I'd say that is the single most overlooked vulnerability in modern wealth building today.
Definitely.
I mean, we are so culturally conditioned to obsess over the speed and the size of the wealth engine, right? That we just completely ignore the structural mechanics of what happens when that machine inevitably powers down.
And that oversight is exactly what we're tackling today. So, welcome to the deep dive. Our mission today is to really uncover the hidden structural flaws in how highly successful people, maybe even you, listening right now, construct their financial lives.
Super important topic.
It is. We're pulling our insights today from a really brilliant piece of writing by Blaise Tamo. It's titled Beyond Referrals: The Architecture of Advisor CPA Collaboration.
Yeah, Tamo is the founder of Lifeline Legacy Financial Group.
Right, and the creator of the Continuity Bridge framework. And what he reveals in this source material about the fragility of modern wealth is genuinely eye-opening.
It really forces a complete paradigm shift. I mean, he is essentially pointing out that being highly skilled at making money is absolutely not enough if the underlying architecture of your wealth is, fragmented.
Yeah.
Tamo argues that the ultimate financial cheat code doesn't lie in some secret investment strategy. It's actually in fundamentally altering how your financial professionals interact with each other.
Okay, let's unpack this. Because Tama starts us off by looking at a very specific and surprisingly rare moment in wealth management.
Oh, the collaboration piece.
Exactly. He asks us to observe what happens when a CPA and a financial advisor stop merely tossing client referrals back and forth and actually sit down to build a shared planning framework, like looking at the exact same client files simultaneously.
And that shared visibility changes absolutely everything.
How so?
Well, in the traditional model, a partnership between an advisor and a CPA it's purely transactional.
Right, like I'll send you my clients who need tax prep, you send me yours who need asset allocation.
Exactly. But when they actually overlay the tax blueprint on top of the investment blueprint, Tamo notes that massive, glaring structural gaps suddenly become visible.
Across the portfolios of families and business owners who appear, wildly successful on paper.
Yes, the flaws are just sitting there, completely hidden, until you look at both blueprints at once.
Let's ground this in a real-world scenario based on the dynamics Tamo describes. Imagine a business owner. Let's just call her Sarah.
Okay, Sarah.
So Sarah spends 20 years building a highly successful manufacturing company, and she finally sells it for $5 million.
Huge win.
Huge win. Her CPA handles the corporate tax return for the sale, and then her financial advisor takes the net proceeds and builds this beautiful diversified investment portfolio.
Right. And on the surface, everyone did their job perfectly.
Exactly. So where does it go wrong?
Well, what's fascinating here is the psychology behind how the gaps form in that exact scenario. Sarah is a victim of what Tamil calls fragmented decisions.
Fragmented decisions.
Yeah, because Sarah went to the CPA to solve the tax problem of the sale, right? And then she went to the advisor to solve the investment problem of the cash. She missed the architectural phase entirely.
Because they didn't coordinate before the transaction. So if the CPA and the advisor had been looking at the same blueprint, like a year prior, they might have realized that an outright sale would trigger an immediate, massive capital gains tax hit.
Exactly. They could have structured maybe a charitable remainder trust.
Or an installment sale.
Right, dramatically lowering her tax burden and leaving her with significantly more capital to generate ongoing income.
But instead, Sarah loses a massive percentage of her life's work to the IRS simply because her professionals were operating in complete silos.
And that silo effect is the root cause. Each professional just expertly solves the specific, isolated issue that happens to land on their individual desk.
The CPA minimizes this specific year's taxes.
Right, and the advisor maximizes this specific year's portfolio returns.
But because they are working in total isolation, the long-term structural integrity of the client's financial life remains completely unexamined.
Which is why TAMO emphasizes that knowledge is only valuable when it is applied holistically.
You know, it really makes me think of building a custom home.
Oh, I like where this is going.
Imagine you hire a master plumber, right? Like the absolute best in the city.
Okay.
And you hire a master electrician, a certified genius.
Right. Top-tier professionals.
Exactly. But you never give them the same blueprint. And worse, they refuse to speak to each other.
Oh, no.
Right? So they both do incredible work individually. The copper pipes are flawless. The wiring is pristine.
But they don't know what the other is doing.
Exactly. Because they didn't coordinate, the plumber ran a high-pressure water main right over the main electrical panel.
Oh, man.
So the day you move in, you turn on the shower, the lights immediately short out, and the house burns down.
Wow. Yeah.
And that's what's happening with these fragmented financial decisions.
That analogy captures the structural danger perfectly. Because when the lights short out in a financial plan, the client is entirely blindsided.
Because they hire the best people.
Right. They assume they were safe.
Yeah.
But why does this happen so consistently? Tamil argues that it is baked into the DNA of the traditional financial planning industry.
Which is what exactly?
Right. It's obsessively focused on the accumulation phase of wealth.
Yeah.
Just piling up the money.
Wait, I want to push back on this a little bit because I think a lot of people listening might be deeply skeptical of that critique.
Okay, lay it on me.
Isn't accumulation the entire point of wealth building? I mean, let's say I diligently save and invest and I reach a point where I have $10 million.
Sure.
Or let's just look at the classic retirement model, you know, the 4% rule.
Right, the gold standard for a lot of people.
Yeah. If I have a massive, well-diversified 60-40 portfolio and I just withdraw a conservative 4% every year, isn't that already an income structure?
I hear you.
So why does Tamo think the traditional accumulation model is fundamentally broken if you simply have enough capital?
It is a totally logical question,
Yeah.
but it fundamentally misunderstands the mechanics of wealth distribution.
Okay, how so?
Tamo emphasizes the critical transition from income dependence to income structure.
Income dependence being...
Your salary, your business revenue. When your personal income engine stops, whether unexpectedly due to illness or market disruption, or intentionally through retirement, your life can no longer depend on a steady top-line revenue stream.
Right. You now have to extract cash from your assets.
Exactly. And if you attempt to use a blunt instrument like a flat 4% withdrawal rate without a coordinated tax and liquidity structure,
Yeah,
you can trigger a death spiral in your portfolio.
a death spiral. Okay, walk us through the mechanics of that. How does pulling a conservative 4% destroy the portfolio?
It comes down to the interaction between sequence of returns, risk, and marginal tax brackets.
Okay, give me an example.
Let's say you need $150,000 to live on this year.
Seems reasonable.
In a fragmented plan, you might just pull that money out of your largest account, which is likely a tax-deferred 401k or an IRA.
Right, that's where most of the money is.
But every dollar you pull from a traditional IRA is taxed as ordinary income. So to actually get $150,000 in your bank account to spend,
Oh, I see.
yeah, you might have to withdraw $200,000 to cover the taxes.
Wow.
And in doing that, you're accidentally bumping yourself into a much higher marginal tax bracket in the process.
Ah, I see the friction there. So your gross withdrawal rate isn't 4% at all.
Not even close.
Once you factor in the inefficient tax hit, you might actually be depleting the principal at like 6 or 7%,
Precisely. Now, compound that with a macroeconomic interruption.
like a market crash.
Exactly. What if the stock market drops 20% that same year?
Oh, that's brutal.
If you are forced to liquidate assets during a downturn just to generate that $200,000 withdrawal to keep the lights on, you are permanently locking in those market losses.
Because the shares you sold at a discount can never capture the eventual market recovery.
Exactly. Your $10 million mountain shrinks violently, not because you spent too much, but because you lacked an architecture designed to distribute the money efficiently.
So to bring back the builder analogy, the plumber and the electrician spent decades building this massive water reservoir,
Right.
but they never engineered a safe way to get the water out of the tank and into the sink. So when you finally open the valve, the pressure blows the pipes apart and floods the house.
That is the exact vulnerability. Traditional plans are designed almost exclusively to build the reservoir. They are, quite frankly, completely blind to the mechanics of managing the flow once the rain stops.
Here's where it gets really interesting. Because if simply accumulating a giant pile of money isn't enough to protect you, the solution has to involve fundamentally changing the conversation you're having with your financial professionals.
Totally. Tamo says you have to move away from talking about individual financial products and start designing a coordinated financial architecture.
And that shift in mindset totally changes the questions your CPA and your advisor should be asking, doesn't it?
Night and day difference. The old questions, the ones that lead to fragmented decisions, they're entirely product focused.
Like what?
Like, which mutual fund should we choose today? Or how can we maximize deductions this quarter?
Just really short-term, isolated thinking.
Exactly. But when professionals actually collaborate, the new questions become deeply structural.
What do those sound like?
They start asking things like, how does the asset location of this portfolio impact the client's marginal tax rates in year 15 of retirement?
Oh, wow. Looking way ahead.
Right. Or how exactly do we move this client from a state of accumulation into a state of reliable, tax-efficient income?
Because every single one of those elements is mechanically connected.
Yes. A decision you make today about your asset allocation directly impacts your future tax burden.
And that tax burden directly impacts the cash flow liquidity of your estate.
Exactly. And that liquidity determines the risk your heirs will eventually take on.
So without a shared framework connecting these moving parts, solving a problem in one isolated area almost inevitably creates a disastrous unintended consequence in another.
And this is the exact problem Blaise Tamo's Continuity Bridge framework is designed to solve.
The continuity bridge.
Yeah. The source material outlines that the purpose of this framework is to bridge the terrifying gap between income dependence, where you're entirely reliant on your business or your salary running smoothly, and financial certainty.
So if the problem is the plumber and the electrician crossing wires, the continuity bridge framework is essentially the general contractor.
That is a highly accurate way to view it. The framework dictates the sequencing. It forces the professionals to route the tax strategy around the investment strategy before the drywall goes up.
So practically speaking, what does that actually look like? If an advisor and a CPA are using this framework, how does it change the client's experience?
It moves the client from reactive defense to proactive architecture.
Okay.
In a continuity bridge model, the CPA doesn't just look at last year's tax return, they look at a 10-year projection of the client's portfolio distributions alongside the advisor.
They're building a map together.
Exactly. They stress test scenarios. They ask what happened to the tax bracket if the client needs a lump sum for a medical emergency in a bear market.
So they're preparing for things to go wrong.
Right. They build dynamic pathways, maybe utilizing cash value life insurance, Roth conversions, or specialized trusts.
So that when the engine stops, the client has multiple tax-optimized buckets to draw from?
Yes, regardless of what the market or the IRS is doing.
This raises an important question, though, regarding the philosophy of wealth management. What does resilient planning actually mean in practice?
Well, Tamoa makes it clear that resilient planning is not about constructing a pristine theoretical model and then crossing your fingers, hoping for zero interruptions in your life.
Because hoping for no interruptions is a complete fantasy. Things always happen.
Exactly. True financial architecture assumes the engine will stop. It assumes there will be market crashes, sudden health crises, and changes in tax law.
So a resilient structure has the shock absorbers and the alternative pathways already built in to handle those transitions smoothly.
Right, and you simply cannot build that kind of multidimensional resilience when your financial professionals refuse to look at the same blueprint.
This all makes logical sense. The mechanics of the framework are sound. But why is Tamo sounding the alarm about this right now?
The timing is critical.
Yeah, the source material makes it clear that this isn't just an abstract philosophical debate about best practices. There is a ticking clock.
A very loud ticking clock.
Right. We are standing on the precipice of a massive historical shift where these fragile, piecemeal financial structures are about to be severely stress tested on a global scale.
If we connect this to the bigger picture, the urgency becomes glaringly obvious. Tamo points out that over the next decade, the baseline level of financial complexity is going to skyrocket.
And that's driven by three interlocking macroeconomic shifts that are already in motion, right?
Yes. 3 massive shifts.
Let's look at how these shifts cascade into one another, starting with the demographic reality of retirement accounts.
Okay, so we are talking about millions of baby boomers who have been aggressively funding 401ks and traditional IRAs for 40 years.
And all of that money has grown tax deferred.
Exactly. The government has essentially been a silent patient partner in those portfolios for decades, just allowing the capital to compound without taking a cut.
But that bill is finally coming due.
It is. As this generation ages into required minimum distributions, or RMDs, the government mandates that those funds must begin flowing out of the accounts.
Whether the client needs the income or not.
Right. And this is going to trigger a tidal wave of forced taxable events.
And if your CPA and advisor haven't spent the last 5 years coordinating a multi-year Roth conversion strategy or optimizing your asset location to soften that blow,
You're in trouble.
you are going to lose a staggering percentage of your life savings to taxes you legally didn't need to pay. It's an entirely unforced error.
And that forced taxation collides directly with the second major shift,
Which is,
the wave of business transitions. That same generation holds a massive amount of its wealth in closely held private businesses.
oh, sure, the local manufacturing plants, the dental practices.
Exactly. Over the next 10 years, thousands of these entrepreneurs will sell or transition their companies.
Which creates an incredibly volatile liquidity event.
Very volatile. They are simultaneously losing their daily income engine and receiving a massive influx of capital that pushes them into the highest possible tax brackets.
Right, at the exact moment their forced 401k distributions are kicking in.
Yes. The tax friction there is monumental.
And that friction sets the stage for the third and arguably the most structurally dangerous shift.
The great wealth transfer.
Right. We are looking at roughly $70 trillion passing from one generation to the next.
But this wealth isn't just sitting in liquid cash. That's the problem.
No, it is locked in real estate, private equities, complex trusts, and tax-heavy retirement accounts.
This is where the lack of architecture becomes truly destructive for the next generation.
Because if an estate plan is built in isolation,
Yeah.
say, a lawyer drafts a pristine will, but the CPA doesn't model the income tax implications for the heirs,
And the advisor doesn't ensure there is enough liquid cash available to cover the estate taxes.
the heirs inherit an absolute nightmare.
They do. They might be forced to fire sell a thriving family business or a cherished property at a 30% discount within 9 months just to satisfy the IRS.
So the transferred wealth is just decimated by unintended consequences?
Exactly. Thomas' core thesis is that in the face of this impending decade of extreme complexity, the professionals who will actually provide measurable value to you are not the ones who react to these events after the ink is dry.
No, the truly valuable professionals are the ones who coordinate early.
Right. They are sitting at the same table looking at the same structural blueprint years before the business is sold, before the RMDs begin, and before the estate is transferred.
Because if you wait until the liquidity event happens, it is mathematically too late to build the architecture.
You are no longer planning. You are just doing really expensive damage control.
And it's crucial to understand that this applies to everyone listening.
Absolutely everyone.
Whether you are a multi-million-dollar business owner preparing for an exit, anticipating a complex inheritance, or simply an everyday professional trying to manage your own 401k as you approach retirement.
You are caught in this macroeconomic web.
These shifts will impact the purchasing power of your life savings. If your advisors aren't actively coordinating with each other right now, the burden of that fragmentation falls entirely on your shoulders. You are the one who will pay the price.
That is the sobering reality of the industry. Without coordination, you aren't actually building durable wealth. You are merely accumulating a larger, more complex set of vulnerabilities.
So what does this all mean? If we bring this deep dive full circle, the takeaway from Blaise Tamo's Continuity Bridge framework is exceptionally clear.
It really is.
A true partnership between your financial advisor and your CPA has absolutely nothing to do with them sharing referrals to boost their own bottom lines.
Nothing at all.
A real partnership is entirely about gaining shared visibility into the mechanics of your life. It's about providing you with coordinated, multidisciplinary architectural planning.
And in a landscape where financial complexity and tax friction are only going to increase, that level of structural coordination isn't just some luxury add-on.
No, it is the ultimate premium service, and it is the only mechanism that actually secures your wealth.
I couldn't agree more.
Before we sign off, I want to leave you with a provocative thought that really builds on what we've discussed today.
Okay, let's hear it.
We are entering an era where artificial intelligence and automation are rapidly commoditizing the individual pieces of financial advice.
Oh, for sure. Algorithms can pick stocks for fractions of a penny.
Exactly. Software can auto-generate perfectly compliant tax returns in seconds.
Yeah, the individual tasks are getting cheaper.
Right. So as those isolated individual tasks become entirely automated by AI, ask yourself this. Is the future of wealth management less about finding a genius who can pick the best mutual fund and entirely about finding the human architect who knows how to build the most resilient bridge between those automated systems?
That's a profound way to look at it. The human element is the architecture itself.
Look at your own financial life right now. If your personal income engine stopped tomorrow, does your setup represent a thoughtful, coordinated architecture? Or is it a fragile collection of fragmented decisions waiting for the lights to short out?
It's something we all need to ask ourselves.
Truly. Thank you for joining us on this deep dive. We know your time is valuable, and taking the time to truly understand the mechanics beneath your money is the critical first step toward real certainty. We will see you on the next one.